A random walk down Wall Street. Number 1. What is a random walk and key takeaways? Hello everyone! Welcome to the AI Finance 101 reading series. I'm Miss CSPX. Today we begin our journey into a classic finance book, A Random Walk Down Wall Street. The author is Professor Burton Malkie, who has served as a member of the U.S. Council of Economic Advisors, Dean of the Yale School of Management, Chair of Princeton University's Economics Department, and a board member of several Fortune 500 companies. He combines theory, practice, and policy experience all in one. So, what unique insights does he have about financial markets? Today, we'll introduce the random walk theory and the basic concepts of investing. This session covers 4 sections. 1. The core of the random walk theory. 2. The difference between investing and speculation. 3. 2 major asset valuation methods. 4. Historical speculative manias. Let's get started! Section 1. The core of the random walk theory. Professor Malkie begins by introducing the random walk theory, a classic academic viewpoint that argues stock prices in the short term are unpredictable. According to this theory, the profit forecasts of investment advisors, the recommendations of TV stock pundits, and even the predictions of chart-based technical analysts are no better than a monkey throwing darts at a board. However, Wall Street professionals strongly object, countering with 2 main weapons: fundamental analysis, analyzing a company's financial data and prospects to determine intrinsic value; technical analysis, predicting the future by studying price trends and chart patterns. The debate between academia and Wall Street continues to this day. Some scholars now compromise, suggesting markets may have a degree of predictability. This ongoing debate forms the foundation for understanding markets. L'entreprise, Section 2, the difference between investing and speculation. So, what is investing? Professor Malkie defines investing as purchasing assets to generate reasonably expected income and achieve long-term capital growth. In contrast, speculation seeks short-term gains, hoping to profit in just a few days or weeks. The core purpose of investing is to combat inflation. Without inflation, putting money in risk-free products, like bank deposits, would steadily grow through compounding. But inflation erodes wealth. If investment returns don't outpace inflation, assets shrink over time. Therefore, the key to investing is choosing assets that appreciate in the long run. This brings us to asset valuation. Section 3. 2 major asset valuation methods. There are 2 mainstream approaches to asset valuation. 1. Firm foundation theory. This theory holds that every asset, such as stocks or real estate, has an intrinsic value that can be determined by analyzing its current state and prospects. When market price is below intrinsic value, it's a buying opportunity. John Williams introduced the discounted cash flow (DCF) method in the theory of investment value, discounting future dividends at a fixed rate back to the present. For example, with a 5% discount rate, $1 a year from now equals 95 cents today. The theory was later expanded by Irving Fisher and by Benjamin Graham and David Dodd in Security Analysis, profoundly influencing Wall Street analysts, including Warren Buffett. They believe buying undervalued stocks leads to profit. 2. Castle in the Air theory. Proposed by John Maynard Keynes in 1936, this theory emphasizes psychological rather than financial value. Keynes compared the market to a beauty contest, where the winner isn't the most beautiful contestant, but the one most people think others will find beautiful. By analyzing investor psychology, Keynes himself spent only half an hour a day on investing, yet earned millions of pounds and grew Cambridge University's endowment tenfold. Under this theory, buying stocks is essentially a greater fool game. As long as someone else is willing to buy at a higher price, the current price is justified. Section 4. Historical speculative manias. Professor Malkie reviews speculative manias in history, revealing the roots of market irrationality. The 17th century Dutch tulip mania is the classic example. Tulips infected with a mosaic virus developed unique stripes and became highly sought after, pushing prices to absurd levels. People traded land, jewelry, even furniture for tulips. Call options also appeared, For example, buying a tulip worth 100 guilders with an option costing 20 guilders. If the price rose to 200 guilders, one could profit 80 guilders. But in February 1637, some began selling, triggering a collapse. Government rescue efforts failed, and tulips became worthless. Many lost their fortunes. This bubble exposed the madness of speculation, but speculation didn't end there. An even larger bubble was about to unfold in the 18th century England. Chapters. Conclusion. Today, we began our first lesson on a random walk down Wall Street, introducing the random walk theory and the core concepts of investing. We explored the unpredictability of stock short-term prices and the academia versus Wall Street debate, the distinction between investing and speculation, emphasizing the fight against inflation. The firm foundation and castle in the air valuation methods, showing different investment logics. The Dutch tulip mania, illustrating the dangers of speculative bubbles. These concepts lay the foundation for understanding financial markets. So, what happened during the 18th century English bubble, and what lessons can we learn? Remember your next episode preview. That's it for today. Next time, we'll continue our journey through a random walk down Wall Street, diving into the speculative bubble in 18th century England and more insights into market behavior. If you enjoyed this AI Finance 101 reading series, please share it with your friends so more people can join our learning journey. I'm Miss CSPX, and I'll see you next time.